Hello everyone, welcome to Please Remove Your Shoes again. As you know, this past Wednesday, Bank of Canada increased the overnight lending rate by 0.25 basis points to 4.75%. Buyers who are borrowing money typically will back off naturally and psychologically because of the higher borrowing cost. Typically, when interest rates are rising, prices tend to drop. So the price of the home that you were going to purchase before the rate hikes can now be purchased at a cheaper price. This can be an advantage for the buyer depending on the type of property in the neighborhood they're seeking. As you know, last year we experienced 7 interest rate hikes in order to cool down the Canadian housing market. This year, we started off slow. However, we experienced more buyers come back into the market since Bank of Canada announced to hold, not increase or decrease the interest rates in March and in April. So that alone is a sign that there are a lot of buyers waiting on the sidelines for interest rates to go down, which is completely understandable. Ladies and gentlemen, my name is Canoglu. I'm a realtor in London and surrounding area. Here at Please Remove Your Shoes, we touch base with the real estate market weekly and neighborhoods in London and surrounding areas. Please hit that subscribe button to stay updated, and we're going to break it down in two different scenarios like this. We're going to talk about single family detached homes before the rate hike and the rate drops. As I mentioned earlier, before the rate hike, prices are typically higher, and after the rate hike, prices tend to go down. How much will it go up or down will depend on the type of property and the neighborhood. In this example, we're going to use average numbers for single family homes in the 1,500 to 2,000 square feet range in all of London. So we're going to use a home that could typically be purchased at $700,000 in London before the rate hike. You can use this example in other cities as well, with numbers adjusted, of course. And again, this is just an example. Everyone's financial situation is different. Everyone's lending conditions are different. Debt ratios are different. Credit scores are different. So this is an example. So you have to adjust the numbers according to your case. And we're going to assume that the prices will drop about 10% in average after the rate hike. And we're going to use 4.5% and 5% for our interest rate examples. 4.5% after the interest rate drops, and 5% at the interest rate hike. Because of the current uncertainty in the market with inflation, economists are recommending 2 to 3 year fixed terms. That's why we're working with 3-year fixed rate to be safe. In the two scenarios I mentioned, it goes like this. You have a purchase price at $650,000 with a 5% three-year fixed. Your monthly principal and interest will be $34.70 if you have 10% down with a $144,000 household income. With your purchase price at $700,000 with 4.5% 3-year fixed, your monthly and principal will be $35.56 if you have 10% down with a $147,000 household income. That's a difference of $86 for your principal and interest. So if you were to purchase at a higher interest rate, you will actually be saving around $3,100 in 3 years, given that the prices have dropped on the single family home that you're looking for. Again, this is just an example. It may or may not be the same in your case, depending on the lending conditions. Your debt ratios and your credit scores are going to be different, but it is definitely something that you should consider. And if you have any questions, please give me a call. I'll link my contact info in the description box. And until next time, please remove your shoes.